Alan De Janaro, and I have been given the privilege of moderating this session by the organizing committee. Before we get started, I'd like to say a few words about our speaker. Marco is a well-known researcher in math finance with many contributions to the field. Among many, I'd like to highlight his influential work on uncertain volatility models, UVM, for pricing options, which has more than 1,000 citations. The original idea is still relevant and continues to drive the academic research in option pricing and more recently in model risk. But Marco also has an outstanding capacity for translating real-world problems from the financial industry into elegant and simple solutions, as you will see in his lecture. Last but not the least, Marco is always available to help and advise if you need it, not only in English, but in Spanish, French, Italian, and even in Portuguese. So, without further ado, I will give the floor to our speaker, my co-author, and my friend, Professor Marco.
Thank you very much, Alan, for this warm introduction. I would like to ask everybody if you can hear me. Hello?
Yes, yes, we can hear you.
I know it's important for me to. Okay, great. So, yes, so wonderful. So, I am going to first begin by thanking Georges Zubelli and the team from IMPA Rio for organizing this meeting, and I'm very honored to have been invited and mentioned several times. And I would like to tell you guys that the reason why I'm a mathematician is in no small reason due to IMPA. But perhaps you don't know the story. I'll just take here's a story. When I was young, my parents had moved to Búzios, Rio de Janeiro state. And, once I was just talking casually to a girlfriend, and she said to me, "Oh, you like math? That's good," because my sister is dating a guy called João Portinari, was the son of the famous Brazilian painter Cândido de Portinari, and he is a mathematician. And he said, "Oh, really?" He says, "Yes, the best place in mathematics in South America is the IMPA." I said, "Really? You should go." So, maybe a year or two later, when I managed to get my act together, I used to take the bus and go from Búzios to IMPA, and I took a class with Elon Lages Lima called Introduction to an Analysis. And that's what later Professor Ellen told me that I should first get a degree, because I didn't have a college degree then. And that's how I pretty much was sent on my way to becoming a professional mathematician. I had no idea that a few things that happened in Búzios along the way got me to IMPA, and then got me to go back to university, and eventually ended up being a professor. So thank you very much, IMPA, since then, and also for inviting me today one more time, and for all the support in all the years and all the conferences we did in here in Rio. Rio means research in options in Rio. So I also am very thrilled to see that Khalifa University is now a sponsor, and that maybe there's a trip to Abu Dhabi somewhere in the future. So that is my road from Búzios to Abu Dhabi. It passes through IMPA. Okay, so having said that, I will begin my presentation today, which is called A Brief History of Core. And subtitle is Recent Advances in Modeling Liquidity Risk and Options in Central Clearing, Central Clearing, Applications to Central Clearing. So there's a lot of stuff, very busy. And basically the idea is, number one, well, let's go through the outline. I'm going to talk today about liquidity and risk management. So that means that when you manage the risk of a portfolio, you always have to take into account the liquidity of the instruments that you're considering. Are they instruments that are easy to trade? Will you move the market when you trade them, and so on and so forth? And this obviously important issue was brought to my attention about 10 years ago when I was a consultant with B3. B3 is a company in Sao Paulo, which is resulted of the merger of the two largest exchanges in Brazil, BM&F and Bovespa. BM&F is the futures and commodities exchange, which is famous, very famous because of its futures contracts that are very big. And also, Bovespa is a stock market, Brazil. Bolsa de Valores de São Paulo is the acronym. And these two companies merged in the 2000s and then eventually formed BM&F Bovespa. First, it was called BMF Bovespa, and now it's called B3 because it added a few other businesses that they have, always in the business of central clearing, such as I don't want to go into the details right now because maybe there's not that important. And this slide there's a little mangle is that I try to put all this, but my PDF editor is not that good. So basically, what is very important in what I'm going to talk about for B3 is how to take into account the fact that BT has many, many clients that leave collateral with them. In other words, they leave financial guarantees, let's say bonds or derivatives or portfolios of stocks. And if there is a problem, they must be liquidated, must be closed out. So these guarantees are there in case there is need to provide liquidity, provide cash, provide liquidity to the clearinghouse, to their business, and therefore I will get into that in much more detail. So the idea of liquidity was very prominent. Also, B3, the Brazilian Stock Exchange and Futures Exchange, are very they manage many different products, and also they're very conscientious of the risks that they take, because sometimes they operate in the listed market, and also sometimes in the over-the-counter market. Over-the-counter markets are markets that are not in exchanges, but rather between dealers. So they have to have all these things, all these different modalities, and they do. And all this exists already, tried for many, many years. In fact, Bovespa is probably one of the oldest institutions in Brazil. So they have been continuously improving their technology. And at some point, we crossed paths, and that was very good for me. And I was able to do some work with them, and I like it a lot. So we will go back to Bovespa and to, well, B3 now. I'm gonna always call it Bovespa because I'm an older person, but it's known as B3 now. And also the other concern, and liquidity is a big concern everywhere, even if you're not in Brazil. Modeling risk as just value at risk doesn't really describes what happens if you face a liquidity problem. So I quickly want to rattle over these examples. For example, long-term capital management, which is a big event that happened in 1998, was a hedge fund that was long short bonds, zero duration risk, but they lost a lot of money when they had to unwind those positions because they were all illiquid, and they were faced by few people. The credit crunch, i.e., 2007, 2008, is also a problem for companies like Bear Stearns that were trying to unwind illiquid derivatives. J.P. Morgan's CIO event in 2012 also was a liquidity problem, as was MF Global, a company operating out of CME that cleared CME, and had a lot very illiquid positions. For example, 2-year term repos on Italian government bonds. And in Colombia, Grupo Interbolsa also made a very big, has a very big collapse due to share repos. So liquidity is very, very important. So, and this is going to be a talk related to liquidity modeling. So liquidity is the ability to convert a given position into cash, or almost like cash, but size of your position matters. That's the first thing you know when you think about liquidity, because the liquidity means that the price at which you will actually get out, will exit the position, let's say, is always going to be, it's going to slip. So it's going to be essentially proportional to a function. It's going to be a function of how big the trade is. And academics have usually used power laws for that. And so there's a very theoretical part of the liquidity business. And the question is, why do we care? Well, because when you do models for risk management in the context of financial infrastructures such as B3, you really have to have a function. You have to be able to calculate your liquidity risk in advance, because you have to charge for it. In other words, in the margin calculations, or also pieces of the margin calculation have to take into account the liquidity risk, i.e., how much risk you're going to have if you have to suddenly liquidate a large portfolio. And size matters, and time horizon matters. Those are the two things. And market structure matters too, because over-the-counter markets have a different price liquidity discovery. That means that in one place you would ask the dealers what the price is, in other places it's on the screen. It's very different. So we mentioned that already. So what is a liquidity adjusted value at risk? So suppose you want to create a risk measure for your portfolio. So one way to do it is just to say, well, the volatility of the portfolio is so much, so I'm going to charge you the value at risk, 3.3 standard deviations or whatnot, but you won't be able to do it all in one day. So you have to stagger it over. But how do you do that in practice? It's not so simple. And as a matter of fact, maybe you have to do it in one day. We'll go further into that. But you have to know how much it's going to cost you to liquidate that in the market. So the way you can think about this is that first, there is an event that makes one of your counterparties default. And so you need to ask them for some money in advance. But then you also have to take into account that liquidating that portfolio that you hold as a guarantee will take several days and more sometimes. So you need to think that there will be further losses coming the next day and the next day and the next day. And all this together is a problem of understanding how much margin or how much value you have to trade in front of a CCP. So continuing with the liquidity curve, the idea is that the liquidity is a function of size, and one possible size would be super linear size of the portfolio size, not linear, because obviously the more stocks you have, the more is going to the risk is going to be something, but it's a little bit super linear because eventually you become the market. If you have too many shares, you are the market and no one is going to trade against you. So a liquidity adjusted VAR, often in the industry, you see it as a VAR, standard VAR, or value at risk, or whatever measure you want to put here, plus a term reflecting the risk and the size of the portfolio. That's how it works. And that's what is more or less understood. But how do you compute these numbers? What's the formula? So first of all, let's start with a simple liquidity model just to get the flavor, because you think out long enough, you will always come up with something like this. This is a good point to mention also that liquidity risk modeling was, for example, the subject of Almgren and Chris's famous paper of the year in the early 2000s of Neil Chris and Robert Almgren. And so whatever you do, something like this will happen, right? You start with a notional quantity of shares that you want to liquidate. Okay, then you consider what a normal number of shares you could liquidate without moving the market, Q0. Then we also consider the volatility of the shares, price volatility. And then you consider the ratio of your position to the typical trade position. So typical trade is what you do without moving the market. So in a sense, it's your speed limit per day, let's say, about trading. And then you say, well, every day I'm going to be subject to market risk. So I'm going to have a random variable every day that multiplies my position and the volatility throughout the liquidation period. So let's say that every day I liquidate Q0 shares that take n days, and this is the volatility of obviously it's the multiplying is diminishing because I have more shares. This is your shock, which is, however you want to do it. For example, an IID distribution. And so if you write this, you can quickly transform this into an integral. This is a stochastic integral, to be precise. What you simply do is you scale the volatility by multiplying and divided by square root of n, make it into a daily shock. Then you now find out quickly that this is equivalent to a power of 1.5 times the original quantity. So it's original quantity times 1.5 multiplied by some number, which is like 1/3 or something like that. Because this integral, 1/3, no, times a Gaussian, but the variance of this Gaussian is like 1/3. So this is a Gaussian because this becomes a stochastic integral. And I hope this is not too difficult to follow. The idea is simply that coming with real parameters like number of shares, typical share size that I'm going to trade, price volatility, comparison of your size with a typical small trade, and putting some stochasticity uncertainty on the model, market risk. That market risk is going to translate into a P&L, and that P&L is this trading is going to transform into a P&L. This P&L is going to transform into something that is like a Q to the 1.5, quantity to the 1.5. And so that's a simple back of the envelope calculation for liquidity risk. Scaling, basically it's a dimensional analysis argument. And so in practice, in the industry, people have done many times, they have come up with liquidity add-ons to the VAR, which have this form. So if you add to the value at risk, typically, you add something like this, or this is called a liquidity charge in some things, in some context of risk management. I'm going to skip this example because it's not that interesting. Now I want to take this to the context of B3, which is B3, by the way, has their model is called Core. We're going to go into it. And so this is a situation that a clearinghouse has. The clearinghouse is a very interesting element, is what we call a financial infrastructure. Financial infrastructure is things that make markets possible, right? That eliminate credit risk and certain uncertainties from the market, and that have been used for at least 100 years in some cases. Typically, instead of trading with other people you trade in an exchange, but in addition to that, someone else, you basically trade against the clearinghouse. So if, say, clearing member M1 really wants to make a clearing, broker 1 wants to trade with broker 2. The way this is done is, okay, they can trade by phone or nowadays by computer, but the point is that there's a credit situation that guarantees that the trade will go through. And this is what is known as a clearinghouse structure. In the world, everything is done via clearinghouses, and is going to continue that way. And also, the trades themselves, there's another thing called trade repositories, which is where the trades are recorded, and also and also asset depositories, which is where the and banks and so forth. So this is the kind of ecology that makes trading possible. And in our case, we're interested in the risk which the CCP is subject to as the CCP trades with his different customers. The customers are people who are called clearing members. They're qualified. They have a lot of capital, and they basically will. If this guy trades with this guy, this trade is now decomposed into two trades. One, this guy trades the CCP. The opposite, the CCP does the other side, but the CCP is essentially responsible for that both parts become good in the trade. And how do they do that? Well, in order to do that, the CCP must require margin, requires different kind of safeguards, margin, cash. That could be structured in many ways. It doesn't have to be one. It could be an initial margin, a mutualized margin. That means a margin that you're going to save the. It's going to be required. It's going to be a mutual part, and then there's going to be an individual part. And so this CCP, for us, you have to think that this CCP is going to be B3. B3 has worked with me for several years, and we stopped for a while, and now we're working again because B3 is not only is a clearinghouse and an exchange, it is also a technology company. A lot of these financial infrastructure companies have become technology companies that sell risk management. They sell the tools to be able to understand the risk of a portfolio. They either sell it to their clearing members, and more recently, they sell it to other CCPs. So there is a network of CCPs as well. And it is quite possible that you want to be a CCP in, say, a country like China, where there's very few clearinghouses at this moment, and they're very concentrated. As China opens its markets to more participants, maybe some other companies want to be CCPs and they want to use risk management. And that risk management, they were going to use branded risk management. That is risk management for CCPs that are successful, such as a CME or let's say B3 or like OCC. So the major clearinghouses today are very quickly for check payments, so for wire, it's called ACH. For securities, Depository Trust and Clearing Corporation, DTCC, LCH in Europe, and Eurex Trading, which is a clearinghouse in Germany for derivatives. In clearing derivatives, so you don't only clear stock portfolios, we also clear bond portfolios, but also the specialty is, the most interesting one is derivatives. And in derivatives, you have the CME group, LCH ClearNet, Intercontinental Exchange, also known as ICE, ICE Clear Europe, Eurex Clearing, Hong Kong, Exchanges and Clearing is a Knoll clearinghouse. In options, you have the Options Clearing Corporation. And in Brazil, B3, as I said, manages 4 CCPs for different asset classes, just like CME Group. It's a holding of CCPs. But since they face the same clients, maybe the Brazilian bank Itaú is a position maybe in one clearinghouse for stocks, maybe in another clearinghouse for derivatives. There are synergies to be made when you're able to, if you can. It's not always a good idea, but in many cases it is, where you can create one big guarantee so that the customer or the clearing participant, what they do is they basically post margin for all their businesses together and benefit from diversification. That's the dream. It's not always easy to do. That's not only from a mathematical question, but also because there are natural bound limitations. But it's very important to have clear that the liquidity risk and market risk are very, very important in the context of clearing houses. And it's going to be like that for the next few decades to come. So just to finish this part of the talk, if you want to know more about the PFMI documents from Bank of International Settlements, they have a lot of acronyms, so I get confused. There is a paper called Principles for Financial Market Infrastructures, and that is a document issued by the BIS in Basel, and it becomes after a lot of consultations, it becomes the basis for regulatory rules which apply to different countries, such as or jurisdictions such as Brazil or South Africa or China, Hong Kong, Europe, and depending on everything is based on. If you want to go to the basis of understanding why these things are used, you have to read these things. They're not that hard to read. And in Europe, it's called ESMA. So, okay, so there are many questions, but they're technical. Let's talk about the Brazilian system. Close out risk evaluation. So about just after the merger of Bovespa with BMF, which happened in the middle of the last decade, under the auspices of a great financier in Brazil called Edemir Pinto, who was the head. He was the guy who basically was the architect of the merger between Bovespa and BMNF, and it was the end of a beautiful career of Mr. Pinto in seeing the future of Brazil, the future of the São Paulo markets, from being small markets, or not that small, but being traditionalized and what we call mutualized, with members owning shares, to become share companies, corporations, which could issue shares, invest in technology, and become powerhouses. That was done in Brazil under Edemir Pinto, and Edemir Pinto is a person that I met and who started together with the technical teams of BMNF Bovespa to create a core. And some people in the audience I know have worked in core. So this is to tell you, this is my understanding of core, and it's been evolving ever since. So the idea of, given the way the Brazilian system is designed, and I don't want to go into too much details, Brazilian system is very focused on the client. So you cannot be represented by you are represented, but your risk is yours. It's not, you cannot hide behind your broker's portfolio. In a sense, the Brazilian financial system is such that every trader, every trading company is margined independently and supervised by the regulator. So there's no, like Wall Street, layer in the middle. There's no layer where you can, so you can't call 10 brokers and know what the total risk is. There are about 2,000 accounts in Bovespa that you have to risk manage. And you have to, and also Brazil likes to do things fast. So now they're going to real time, right? So there's some documents that I left here in case people are yeah. Let's see if this is, yeah. So this is the basic idea. Let's go on the basic idea, which is, instead of thinking of a portfolio, this is a diversified portfolio with futures, stocks, ETFs, and share futures. So this would be essentially the position, right? If you think about it as a portfolio. But if you have liquidity, you can add a line to this description, and Courant does that. And this line is, what is the amount of liquidity that you can trade in and out of this without significantly moving the market? So this is like your speed limit. So for instance, here in dollar futures, the speed limit is 25,000, You have a position of 2,000, no problem. You do it pretty easy. But if you go to this small Brazilian stock, Guararapes Confecções S.A., you have only a liquidity of 1,000 shares and your portfolio is 53,000. It's going to take you a while to get out of Guararapes, and everybody's going to be it's going to cost you money. And here you have a case, for instance, of Vale 5, which is Vale do Rio Doce, which is a stock. I don't know. I just like to talk. I know a little bit about these things, but I traded some of these because this trades in the United States, Vale. So does BOVA. No, yeah. And Bovespa futures, you can trade them here too. But anyway, the point is that there are lots of products, and the thing that you have to do is you have to attach essentially a quantity, which is the maximum quantity you want to trade per day. And this number here, I proxy it as 10% of the average trade volume. This is for core, this is a parameter. So core, the B3 universe trades a lot of different portfolios. But for each of them, core parameterizes how much you can trade per day. It tells you, look, your speed limit per day is 25,000 in dollar futures. So if you have more than that, it's going to take you more than one day, and then the market is going to move. So liquidity here comes into a speed, is like a speed limit. That's how they see it. And if you look at that little calculation I did at the beginning, it is something of that nature where I call it Q0. So therefore, the abstract description of a portfolio in the input of core is basically the following. For each different position, you have a mark-to-market function, which depends on time to maturity or time, a risk set of parameters, the quantity that you have, and the liquidity. This mark-to-market function is really the model that you use to price your derivative. So in the risk committee of clearinghouses, each derivative is given a model. For example, Black-Scholes would be the model for stocks, or Black 76, or Garman Cohagen if they're American. Then you also have a risk factor. Risk factor, for example, is a time series because they could change, right? And for each day, the R could be stock, vol, rate, and dividend. Though dividend doesn't change much. I would say at least stock and volatility. And and also if you think about the Brazilian context, there are the dividend part. You're looking at the dollar BRL. There's an interest rate for dollars inside Brazil, and an interest rate for the US dollar at the Fed, which is a different rate. Those are called the coupon cambial, and of course, and so all these are risk factors that may affect the value of a derivative, of course, of a futures. And what's important to remember is that they use the quantity that they're going to trade and the maximum amount you can trade. And then and also because it's a derivative, usually the risk factor involves other things like implied vol or the stock price for another stock that is, it's the future stock or the futures, whatnot, future on a stock. And now comes the core algorithm to liquidation of a portfolio is done with a closeout strategy. So at time t equals 0, that is before you collect the collateral, when you calculate the margin from a client, you have to say, hey, maybe I'm going to have to start liquidating you maybe in a day if you don't. There's a period that you don't know if the person defaulted or not. It's a very important point in practice. When do you make that phone call and you say, hey, send me money or we're closing you? That could be whatever date that is. Here I call it t equals 0, but it can give them a day or two. That's in the rules. And so basically after that, you have to come up, the core has to come up with a percentage, essentially with a quantity, right? Which a quantity Q that you can trade per day, right? So a strategy will be a fraction of the position in instrument I that we created at date T. And then the remaining part, we call it N of T, which is what you still didn't liquidate, which is what's missing to liquidate. And the sum of this is equal to 1. Sum of the Q's is equal to 1. So this is just a way of formalizing the idea of how much am I going to liquidate each day. So the idea of closeout strategy, or the close strategy, is to basically set up a plan, a logistic plan of how much you're going to trade out of that position every day, understanding that things are going to matter. And therefore, at the end of the campaign of liquidating your counterparty, you will have accumulated a certain amount of losses, either by, mark-to-market losses or realized losses, losses that are unrealized, or losses unrealized because they're paper losses, or real losses because you sold the, and that's basically the idea. So this will be set. So now I don't want to get into much detail. This is what, if for example, on any given day for any given product I, day T, and risk factor R, you have the difference between the initial value at time 0 and the value at time T, and this is essentially what the difference of that is. What the difference is what you lost, or if it's negative, certainly you lost. Otherwise, it's a paper thing. This is essentially, this is what happens when you look at an asset I after time T. This is what it's worth at the beginning with the model. This is what it's worth today with the model. This difference is and so notice that we emphasize here that we're doing a full valuation. So this could be a model where the risk factors can be quite complicated. And then the realized P&L is essentially the sum of the losses as you keep trading out into, and the unrealized are these balances that still stay in the book, which you can also have with you. So all this is how you are. What are the losses, or what is the profit and loss as you start liquidating? The idea is not to make money during liquidating, but it's more to come up with a way of rationalizing how you liquidate a position. For example, the first thing so this is the accumulated P&L, from this is the cash part that was realized, and this is the unrealized gain or loss. And this is something that you can, if you know the functions, the matrix QIS for each security and each time how much are you going to liquidate, then you can come up with a loss. You can think that this is how much you're going to lose under a scenario R. And the idea is, what's the objective function that you want to minimize? So this is the problem that Core set out to solve in 2012, more or less, almost 10 years ago, and this is as a basis for Core. This, of course, has to be instantiated for every security, and so for each security, there is Core determines a liquidation plan, just like in the abstract. For example, for those who are familiar in math finance with the Almgren-Kris model, it is the equivalent to Almgren and Kris. And here, what I am doing in what I did in the beginning of the presentation is I showed you this for a TWAP strategy where I liquidated maximum speed each time. So anyway, the objective function that we wish to minimize is an important problem. It's been debated. one way is just to take the worst loss of the worst, so take the worst loss for a given risk factor, and then to look at the worst case for all risk factors, and this is an objective function. It's a bit harsh, and it doesn't use what we know about risk measures and so forth. So, but it can be set as a linear optimization problem. I skip the details. And so that can be converted into a linear programming thing, and it has been solved in many cases. And more recently, BBMF Bovespa or B3 are focusing on using things like VAR rather than looking at the worst case scenario, the minimum loss, the worst loss over all risk factors, to look at this same thing, the minimum loss over time, and then do a VAR of the minimum loss over time. The VAR, I'm not going to say this in math, but the minimum loss or the minimum value, it's essentially it's essentially what you do, say, when you're looking at the minimum, the maximum draw, the minimum of a stochastic process. So you're really computing the VAR, or the expected shortfall, where the risk is the minimum risk during the liquidation period. And in some simple cases, this can be mapped into a absorption problem. If your assets were following a diffusion, or a portfolio was following a diffusion, it's essentially it's completely computable. It's somewhat computable. Computedly, nothing is completely computable, or is, but suitable modeling makes it computable. Right. So the next topic that I want to talk to, well, so this is core, right? So is core good? Is core bad? Is core something that we like because it's done in Brazil? Well, the answer is all of the above. But one thing that's going to be important is core something that other people like? Is it something that's accepted by the industry, so we can actually create so that no one complains, so that it's the proper amount of risk it's the right charge for the risk. Is it too little, too much? So this is not just saying B3 is a technology company and they have a great system, but it's understanding how the system sits in the universe of risk management for CCPs. There are many CCPs in the world, and so just because B3 decides they want to do core, is that the right thing? So how can we assess that? Well, we can say, for example, is anybody doing the same thing? Well, we have some kind of a taste for Algorithmic and Chris, and for power laws, progressively charged, as I sketched at the beginning, the Q to the 1.5. So how does it, and core is the same as 1.5. That's the main thing. It's similar to 1.5. But now we're going to, let me just phrase the problem as, what if you had to manage liquidity in a market which is an over-the-counter market? So there's no exchange, but you have to clear. In the United States, everybody, and in Europe and in Asia, Dodd-Frank, 2008, says that everybody has to central clear, even if there's no exchange, through a process called novation, which I'm not going to discuss further. So, so the portfolio is liquidated in an auction because there's no market. You have to call people, and it's like you have to auction the portfolio, and the participants inform the CCP on the liquidity and the market depth. So, what if I had to liquidate this? Can I do it? How much does it cost? There's a process for that we'll go over, and it's funny because the guys that are going to bid on your portfolio are the people that will probably have to pay margins. So there's a cat and a mouse problem here that is, so that's why you have to be careful. And yes, so this is So this is what people do in practice. For example, if you go to the CME sends polls, that is enquête, polls. How do you say it in Portuguese? Poll is a, não sei, com Ibope
Consultas, Marco. As enquetes.
Que é tipo, exatamente. So that means that every day the clearinghouse tells members, look, how much would you bid on this swap or on this other swap? And they collect that information every day, and then they do statistics on it, and they find out, they have to know that anyway, because they are going to liquidate. So you have to do it. So, so the way they typically do it is they look at sample portfolios, a portfolio where you're long futures, one where you're long short, where it's like a calendar spread, one that is a butterfly, market neutral portfolios. So it's a list of portfolios, and then they give it to traders or to people in the firms that are responsible for that, and then they come up with a bid-ask spread, either by looking, and they quote it as a bid-ask spread because that's normal, saying if I had to sell you $1 billion worth of your dollar futures, notional, how much? How much do you want from mid-market? Well, that is what people do, and they do it every day. And here's an example: if you had all these typical portfolios, and for example, this portfolio is a 2-year swap, and everything is measured in millions in DV01s, which is like the size of a swap. So here, for example, you have one on swap. Here you have a calendar, portfolio of This is like butterfly. You get the idea. Give them some standard portfolios, and these guys give you back what they think these numbers are. And then you get a, oops, sorry, I did something bad here. Let me try to go back. So, so you get a list of how much does it cost for you to trade, size. This is size, and this is probably, this is a portfolio, and this is, so this is a size 1, 5 times, 10 times, 25 times. That's a big one. And you see how it affects the portfolios. And all this is put in in documentations that are used when people want to know what they expect to pay for closeout. So an idea, my idea here, which I think is what everybody does, is to set this up as a core problem, i.e. as how do I get to numbers like these by using something like core, right? Using all the and the answer to that is, this is for euro dollar futures. Okay, so so here's what they do. They, for example, they take for a 2-year swap. You look at a on size. This is size here, and then you can basically take the pole, smooth it, and it actually turns out to fit into power laws, right? For example, this is a particular smoothing, and this is the power law. So you could try to find out what power laws you get for liquidity charges from the dealers. And what you get are, for example, for a bid-ask spread, which is a function of the size constant, you basically see that you get a regression on log, very simple. And you see that, I think this is fascinating. You actually get 1.5-ish for all the portfolios. I call them spreads here. You get that there's essentially the market will quote. This is purely quotes from the market, from dealers in polls done by CME. You get a number that repeats around 1.6, 1.5, 1.7, which I interpret here as basically I interpret it as saying that core, because core, if you like, is the cost of this. If you think of 1.5 as being 1.5 quantity is essentially a consequence of core. Why? Because of the original calculations that we did on the simple trade, where you use these in-time liquidations. Obviously, this is for a simple asset, but it means that what core is doing is very reasonable. It's not excessive or too difficult to understand. It's simply consistent with a temporal liquidation, which is consistent with the way dealers manage their portfolios. So in that sense, I think that that it is something interesting, which is core is in the market. In other words, what they are asking is not that this is the messages here. Oops. Or maybe I should go to the conclusions. Conclusions is that liquidity modeling is an integral part of risk management. In CCPs, liquidity is essential for construction of a sound margin system for portfolios. Models should include the portfolio size and time horizon. And this is what we call the closeout. That's what the core Bovespa or B3, that's their contribution currently to the technology of risk is that they incorporate in the margin the time that it will take for them to liquidate and the speed of liquidation, which I mentioned is related to liquidity. And they basically, as it says here, they suggest putting liquidity thresholds for each security and finding a liquidity strategy using linear programming or TWAP or whatever. TWAP is like partial liquidation every day, to find a liquidation strategy so that the value of a portfolio is optimized. It's rational. In over-the-counter markets, you have to do it by polls. But the interesting thing is that either if you do it by polls or if you do it rationally, it's very easy to see how the 1.5 model matches. So it's, you have to somehow understand that the liquidity is a price. It's a charge, and you either do it by asking a lot of dealers, or if you're in Brazil, you just do it by hand by creating a technology, not a technology. So Brazil, for example, with this system, B3 is now running something called real-time clearing, or a system of where they periodically scan all the positions and monitor any kind of clear participant that needs more margin, and generate a margin call or a liquidation. I don't think it's automatic liquidation, but they generate a margin call in real time. They can monitor all risk in real time. Since a lot of trading is real time anyway, so you see that this is extremely useful. And systems like these are not taken out of thin air because they have to be explained to clients. Where do they come from? They come from an inventory model, a model of how long and how expensive is it to liquidate your portfolio. And it's easy for them to understand. And we have plenty of evidence that it's the right way to do it. Think about how much you would charge for, how much would the bid-ask spread increase as you increase the size of the trade. And with that, I thank you very much for your attention. And I think I'm within my time. So if you have any questions, please feel free to ask.
Okay. Thank you very much, Marco, for your presentation. It's a pleasure to hear how clear you transform this difficult mathematical problem in something very easy to explain for those not familiar with mathematics. So we have time for a few questions. So, well, I'd like in the meantime, while people are asking the question, I'd like to ask a question or more a comment, Marco. One of the beauties of this formulation is the model itself is a kind of robust optimization problem, right? So you have a set of scenarios, you are optimizing the worst case or some measure, according to these boundaries. And this robust optimization is something desirable when you rely on models for such important things like liquidity and margin requirements. Uh, what are your thoughts about what else can be done in improving or changing this robust optimization model, Marco?
I think that that the original solution that we found was to change the problem into a linear programming problem and optimize like that. That was in 2012. And then what happened is that because if you keep at it, you start asking what the dealers do. And the dealers like to liquidate, to find optimizations that make sense for them, given that they know the conditions in the market under stress. And one of those things is what is the amount of exposure that I can remove from the portfolio. So there's another there are calculations that I have not shown here, many of them, which indicate that this is not unlike a it's not unlike macro hedging. So macro hedging is if you have a multivariate portfolio, you're going to start first, you're going to flatten out your exposure to the major indices. Like in George's talk, if you have an exposure to market portfolio, the best way to unwind is to sell futures so that you have now zero, your first PCA is zero for your portfolio. So that's something that comes out of core. The core will give you that. And how does it give you? Well, a good core, let's say, a good Algorithmic Chris, which let's say is core, will give you that by moving around certain directions of in liquidation space. You can think of a position space as being your state space, and this being like a linear regulator problem, a quadratic regulator problem in control, where you're flowing along certain lines and certain separatrices and whatnot. And basically, it boils down to macro hedging. When you tell this to a trader, you say, hey, if you have a big portfolio, make sure you have zero exposure, zero beta. So your first move is to liquidate beta by making a trade in S&P. After that, you have a portfolio that's market neutral. Now you can see, do I have any sector exposure, or do I have, for example, so someone was asking George, are sectors important? Sectors are very important. I think we all realize why, because the market moves in sectors. So you need to, when you liquidate with core, one of the things that people have tried to do is flatten out the macro exposure to the market as well as to different sectors or parts of the market. And the algorithm can do that, but if you're fast, you don't have to solve the big linear optimization problem each time. You already know that it's going to take, you have to take out those betas out of it, making it go faster and being easier to understand to the compute, to everybody, to program. So more robust, if you like. I think this, you understand that.
Yes, clear.
Yeah,
We
yeah. If you don't like the market today, sell S&P futures. You know, I
yes.
read the other day. That's it.
Yes, and we, from audience, we have a comment from Rama. Rama is saying that the beauty of the model is, in fact, you core derives the square root dependence on the liquidity as a function of the size, and rather than some ad hoc impact model, which is quite common. So yes, I think is one of the beauty of the model, and I guess Marco also agree that is the market impact is endogenously found in this methodology.
Yes. And in fact, it's very fun. It's funny to notice, this is for Rama also, that it gives rise to a power law. So, you you could be like a physicist saying, "Oh, I think there's a power law between bid ask and or slippage and size, and this gives you a natural 1.5 law." Court follows the 1.5 law.
Hmm.
So I think
Great.
that's cool. I agree.
Okay. Okay. I guess we don't have more questions from the audience. So I'd like to thank you, Marco, very much for his lecture. It's always as a pleasure to hear. And so thank you very much.
Thank you, guys. It's my pleasure. The pleasure is all mine. And yeah, thank you.